I'm delighted to be joined by Murali Yaram from Templeton Global Investors, and we're going to be focusing on India and the prospects for 2026. 2025 was a little tougher year for Indian equities. Take me through the reasons why and what you see going into 2026.
2025 has been a very challenging year, even though the market returned about 2 to 3% in dollar terms. There are a couple of reasons for that. Firstly, the earnings growth has slowed down to about 7-8%. Secondly, the valuation premium over other emerging markets has expanded to about 80% compared to the long period average of about 55%. Going into 2026, we believe, I think, the earnings growth is going back to about mid-teens, and the relative valuations are now below the long period average, closer to about 50-55% now. The combination of two should see, I think, the Indian market outperforming the other emerging markets.
We have earnings beginning to accelerate. We see good valuations in the Indian market, but are there any macro headwinds that could knock it off course?
There are certain exogenous events like I think the US-India trade deal getting delayed. It doesn't have a significant impact either on the GDP growth or on the earnings growth. But a foreign investor sentiment point of view and currency sentiment point of view, it's quite important. The second risk is the market is assuming a consumption recovery in India. The job growth at the entry level continues to be very anemic. So if you don't see recovery on the consumption side as much as expected by the markets, you could see a little bit of, I think, downside to the consumer sector.
Murali, three key themes for 2026 that you're following in the portfolios.
You're going to see significant earnings growth in sectors like consumer discretionary, where the earnings growth for 2026 is going to go up from about 10% to about 23%, and metals, industrials, cement, a lot of these sectors are going to see upwards of 20% earnings growth. So you will see a broad-based earnings recovery in India going into next year. And then you also, I think, see the portfolio benefiting out of it because we are overweight banks and we are also significantly overweight consumer discretionary.